From the morning reading, institutional buyers step up at 21.20 as SPX rallies on volume increase. 5 of 10 sectors moved higher on Friday. XLI, XLP, and XLU were the strongest sectors, while XLV was the weakest sector. Oil futures dropped 94 cents to close at 48.66. For the week ended October 28th, only 4 of 10 sectors moved higher. XLU, XLP, XLF, and XLI were the positive gainers for the week. On a year-to-date, your leading sectors are XLE up almost 15%, XLU up almost 12%, XLK up almost 11%, XLI up about 7.7%, XLB up 7.6%, and XLP up about 4.3%, while financials, real estate, and healthcare are down. Breadth strengthened compared to the prior session as decliners led 17.99 to 12.12 on the New York Stock Exchange and led 15.81 to 11.29 on the NASDAQ. On the S&P 500 snapshot, the Friday rally was sniped by the FBI. A surprisingly strong advance estimate on Q3 GDP preceded what appeared to be a reversal of the downtrend over the previous 4 sessions in the S&P 500. At the opening bell, index digested the economic news, which might strengthen the odds of a Fed rate hike, and then rallied to a modest 0.36% midday high. But at 1 p.m., the FBI announced it was reopening its Hillary email probe. The index promptly sold off to its negative 0.64% intraday low. Not surprisingly, that triggered the buy the dip strategy, and the 500 rose to the level of yesterday's close. But selling in the final 30 minutes dropped the index to its 0.31% negative Friday close. The 10-year closed the week at the 1.86%, up 1 basis point from the previous close. Investors have started to borrow against their stock holdings again. For the first time in a while, margin debt is showing growth, rising more than 10% over the past year. When debt goes from a period of contraction to expansion, it has consistently led to gains in stocks so long as that growth is not excessive. Stocks are on track for a third straight monthly decline unless there's a major rally on Monday. October will be the third decline in a row, but with one of the smallest overall losses in its history. When the index has had back-to-back monthly losses ending in October, or when it is still above its 12-month average at the time, it's usually led to gains going forward, but the edge was not large. The smart money is warming up to the Swiss franc. The latest Commitment of Traders report showed a jump in long positions amongst hedgers in the franc, nearing a level that has led to gains in the currency over the past few years. Other notable moves include a new all-time record short position in coffee, a 9-year extreme position in natural gas, and a major drop in the exposure to the US dollar. Traders in the RightX family of mutual funds continue to shun cash. Assets in the money market fund has sunk to 15% of total assets, the lowest since August of 2000. We'd be more concerned if there were a sudden jump in bullish assets, especially the leveraged ones, but so far those are muted. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:32 a.m. Mountain Time, and I am recording this in preparation for the market day of October the 31st, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. At the time of this cut, all 4 of the U.S. broad-based indices were up, with the S&P futures up just over scratch, the Russell futures up over just a bit over scratch, NASDAQ, the most positive, up about 1/3%, and Dow is up just above scratch. Crude oil is down about 0.9%. Euro is down about 1/3%. Long bonds are up just above scratch, and gold is down nearly 1/4 percentage point. In overseas action, looks like everybody's open. China's down just below scratch. Hong Kong also just below scratch, as is Japan. Germany down about 1/4%, and the United Kingdom down nearly 0.5%. In terms of macroeconomic reports for today, of note for the United States, you have core price index, personal spending, personal income, Chicago PMI. So for a Monday, there's a very large schedule. Now, of course, it is also the last day of the month, so there's usually some mutual fund and other institutional window dressing that occurs, so be aware of that. Leading into what should be tomorrow, historically is a bullish day, as the 1st and 16th of the month is when a lot of 401k money comes into the market and becomes invested, pushing those 2 days to seasonal bull side. In terms of the skew has gone up over 125, so we're starting to see some of these volatility measures start to come into warning status. So the skew is in a warning status. That threshold of 125 is the first threshold that we watch, and that triggers a warning that a 2 standard deviation move is about a 9% probability within the next 30 days. So things are starting to climb there. Short-term VIX also climbing 16.69. That's the highest number we've had in some time. Also, if you look at the IV percentiles, notice that we're starting to pop out of the red here. We are no longer in the lower third of the annual range. The S&P is now a 40. The Dow is now a 36. And the Russell and NASDAQ are still at 33 in the lower third. No standard deviation moves were put in on a close-to-close basis on Friday, so we continue to be relatively low in terms of the number of standard deviation moves that have been put in of late. So things are starting to become a bit more volatile, and yet, for the most part, on a close-to-close basis, that price action is staying within a relatively tight range. Let's go ahead and go to the charts, and you can see what I'm talking about. So we're getting, plenty of tall wicks. We see here, here, lots of wick action in recent sessions. Last night's session so far, is a bit of a spinning top. So wicks on all over the place, but the closes are, for the most part, in a relatively tight range, though we have had this pattern of late of lower highs, lower lows, or similar lows, I should say. And indeed, very, very important, this 2100 area has continued to hold. And while we continue to kind of visit the area a number of times, each time the bulls have come in. So we have to give credit to the bulls until that fails, and we have to expect that support will hold until it fails. So it has to prove itself to break down. Our fear, of course, is if we do have a breakdown, we could easily fall to these 1984 areas, so over 100 points, and that could occur quite dramatically in a very short period of time should that happen. So just kind of keep all this in perspective. The bulls are still holding, but we're kind of standing near the edge of a cliff face, and things could get ugly really, really fast should we come off the edge of that cliff. Now, we do have this kind of diagonal resistance above us, and probably more importantly, we do have a horizontal resistance at several levels. The first one here, the second one here, third one near the all-time highs, a lot of overhead resistance. So markets are having a very difficult time making any kind of headway to the bull side, and yet also are not actually really achieving anything to the bear side, at least as of yet. In terms of the Dow, very sideways. I mean, just chattering back and forth. Very, very sideways pattern. NASDAQ. NASDAQ is coming close to the cloud, close to this short-term support area, but has not yet broken through that either. So again, the bulls on the tech sector, tech index, are also able to hold thus far. Now, the story changes when we get to the Russell. They have not held, and this is frankly kind of what I've been expecting of the other indices eventually, that eventually you'll get a break. And with last week's action, we got a break, and you see it was with some robust action, breaking down below the cloud. That's actually a signal to take a bearish trade on the Ichimoku system, and then that certainly has confirmed. Now it's started to run out of a bit of energy and momentum, so we'll see if we get another lower high to go along with this lower low, and we continue to progress downward. But this is not exactly a situation where the bear market, triggers and then all heck breaks loose. It is a much, much more controlled kind of effort thus far. So even in the example of where an index did break, it didn't really just fall out of bed. It seems to be a very, very controlled bearish tone thus far. Okay, so let's go ahead and go to some of the other markets and see what they might be telling us. Now, crude oil, this was kind of important last week as well. It started nibbling at the bottom of this support and then finally had a break, and now has confirmed that breakdown with the action thus far last night into this morning. So expectations for this point is that that crude should fall, and probably to either a fib extension or back into, somewhere around the 46 area probably. So this is probably denigrated into a large, complex, sideways consolidation pattern at this point. So that's not terribly supportive of growing economic expansion when the demand for crude oil continues to fall. Of course, supply is a big part of that question, and the dollar is a big part of that question as well. Gold, while we seem to be just a little bit short-term bullish in recent trading, is certainly not exhibiting an initial fear premium by any measure. The dollar has come down a little bit from the recent swing high, and that certainly could be impacting gold as well as some of these other markets, crude oil, etc. But it's not exactly falling out of bed. So dollar strength remains very, very high. And frankly, at this point, we would be expecting another bull flag on that pattern and for the dollar to continue to go up until proven otherwise. And then let's go ahead and take a look at long bonds. Long bonds continue to kind of unwind, and nothing here telling us to expect anything else. Now you notice I do have the support drawn in at 161, and if we should fall down to that area, that could be a possible area for at least short-term support. So we'll have to continue to watch that as well. Some might argue that we've got a head and shoulders pattern, and that's a neckline. It's not the cleanest head and shoulder pattern I've ever seen, but certainly we could see a head pattern here. We could see a shoulder pattern, and we could probably, mark, 2 or 3 of these possibly as left shoulder. Again, a very, very sloppy pattern if indeed you're going to try to make that into a head and shoulders pattern. But whether it is or not, we certainly have an area of horizontal support across at 161, and that's now being called into question. So kind of be aware of that. And then finally, volatility. Now, volatility is the one market that probably has been giving us a cleaner signal of late, and volatility was climbing all last week. We never actually got a VIX spike where we had a close-to-close increase of at least 3 points. Never had a VIX spike, and yet, we went from a low of about 12.69 to a high of some 17.4. So as a percentage, that's a pretty big increase in volatility, and a consistent climb of volatility all last week, and yet at the same time, not a lot of energy, not a huge move by comparison to what volatility can do. We didn't have a spike like this from September 9th, where you go from a 12 and change and close at a 17.5. That's the kind of spike action that you're kind of looking for. And we've not actually had that yet. So it's notable to see the increase in volatility. The VIX phase is certainly increasing, and yet at the same time, it seems to be this kind of slow motion kind of effort. Now, what they might be pricing in is the upcoming election. And indeed, if you look at the SPX option chain, and look at the when you get to about 10 days out, see here, 7 days out, the implied volatility is 34. But then when you go to 9 days out, and of course the election is now 8 days out, the implied volatility jumps into the 50s. So what's being priced in the short-term volatility is an expectation of volatility following the election. So just be aware that the market makers are pricing in an anticipation of increased volatility, and we'll certainly probably have that around election day. And let's go to the daily report, and things continue to look, frankly, a bit ugly here. We is still in market phase 5, the break of diagonal support, still looking for that break of horizontal support on the S&P. That has already occurred on the Russell. Our 3 market timing signals, the first one from IBD, the uptrend under pressure, is in warning status. The GMI index is about as ugly as it can get at a 1 out of 6 and a 2 out of 8. That sell signal has been in place since 10-12. And then on the third one, the stock chart's decision point is decidedly to the bearish side, with short-term signals even on the NASDAQ now in the neutral to bearish, and really only one lone green signal remaining across those 8 boxes on the short term. On the intermediate term, 3 of the 4 are neutral to bearish as well, with the NASDAQ still holding on to a bull signal, and long term in all 4 of them is still mixed. So overall consensus on these market timing signals is going to be a neutral to bearish, and that certainly is reflected in the chart action, where we've been very, very choppy, very, very neutral, and yet seemingly sliding ever so slowly to the bearish side. Position sizing opinions, both models remain the same as what we had at the end of last week, 50% and 75%. The intermediate term market postures continue to deteriorate on all 4 of the indices. You have only one that's holding on to a weak bull, and that's the Dow. Barely made headway in a positive direction on Friday. The others, S&P now strong bear, NASDAQ strong bear, and Russell severely strong bear. And that, of course, is reinforced by a weak bear sentiment line. So not a lot there for the bulls to hang their hat on. Also, you notice that the strength of the intermediate trend continues to fall and has fallen below the signal line of an 80. So currently, that would be a not a very good sign for the bulls as well. And the hedge warning status to remain at level 2. So this is quite elevated. This is red light. The novices should not be, and indeed, if you look at the strategy opinions, novices should be largely in protection mode and not initiating much in the way of new positions on the bull side at all, and perhaps should start sprinkling in some additional bearish trades. The VIX is actually in the acceptable window, but with the hedge risk level at level 2, that would call for caution on option income strategies. Cover calls and put selling, both of those strategies, with respect to novice traders, conditions are not acceptable to initiate new positions. Aggressive traders might consider very, very defensive setups with a 2-to-1 ratio of in the money versus out of the money strikes, and then also 2-to-1 ratio of low beta versus high beta. Even better, consider legging in through put selling, use a put spread perhaps, and use a position size that you are willing to own. In terms of specific warning areas, we're pretty much the sea of red here at this point. Volatility-based systems, market in decline, sharp increase warnings. The volatility ratio warning fired last week. The daily squeeze is present and ready to fire, though it hasn't actually fired yet. And again, this is that reflection of that kind of slow motion move in terms of increasing volatility. It has been increasing, but we're still caught in a daily squeeze. So looking for that rapid volatility expansion to fire. We've not yet seen that yet, but certainly it's in position to. Current number distribution day count continues to be elevated, and both the NASDAQ and the S&P are currently at 7. VIX phase is increasing. The skew with Friday's action did go up over 125, and we mentioned earlier that's about a 9% probability that we would have a 2 standard deviation move within the next 30 sessions. Current 10-day move out, of course, this takes us just past the election, and that does spike up to over the 50s, actually. In terms of the trend-based warning areas, we do have multiple warnings here as well. We have the market phase 5, the break of diagonal support, the strong bear and the intermediate term market posture, and the New York Stock Exchange new high, new low indicator came in at 499 for Friday. So all 3 of those are in warning status. And the key intermarket risk aversion indicators, all 5 are currently still in risk off status. So when you put all this together, you could make an argument to even go to hedge risk level 2+. I mean, this is just about as much red as is possible to get. Probably the only thing that's holding me from a 2+ is the fact that the intermediate term market posture is still holding up, in this kind of middle strong bear range. We start dropping into the 20s, and I probably would have a stronger case to be able to go to a 2+. Certainly the market timing signals are getting quite concerning. When we go to our sentiment indicators, they're also relatively neutral, with stock short term of 4 and intermediate term of 5. And then, of course, the fear and greed index is starting to really fall at this point, and is now in the outright fear category at a 32. At a 25, 7 points away, it will go into the extreme fear. We did have some sectors that performed well on Friday: industrials, consumer staples, real estate, utilities. Now, 3 of the 4 of those are from our defensive-oriented area, so that is of some note. And in terms of the poor performers, for the most part, these are the high beta areas. And certainly healthcare continues to be pummeled. This is, of course, earnings are driving some things, but also probably some positioning and anticipation of outcomes of the election. And healthcare probably would be one of those losers in an election where, if Hillary were to win, might continue to take some significant pressure. Energy also would be expected to be an area that would not probably fare terribly well under a Clinton presidency and administration. So we'll continue to watch and see how this shakes out. There's an awful lot of unanswered questions there. It's not just about the presidency, but it's about the Senate and the House. And depending on who controls those various levers of government, will certainly have us with some volatility as the winners and losers are sorted out as it comes to individual companies, industries, and sectors. And you can see from a percent change, most of these were negative, and we continue to see quite a bit of red on the 5-day, 1 month, 3 month. So not a lot here for the bulls to be able to point to in any kind of consistency. We have been watching financials as probably the best model of bullishness and consistency, but that certainly on Friday, took a bit of a blow. In terms of the intermediate term market postures. We talked about how many of those were falling on the indexes. Well, if you look at the sectors, the short to intermediate term is also being called into deep question across virtually every single sector. Only financials is holding up with market postures across all three time frames as positive. You probably should start taking a look at where the consistency is to the downside and consider starting adding in, some more bearish exposure, more bearish swing trades. Healthcare, consumer discretionary, and retail would certainly be three sectors to start that watch list process. And then the relative rotation graph, for the most part, and you see this is almost like a washing machine where things are just chopping around. One moment they're positive and then they roll over. The next minute they're rolling over and then they start to improve. But a lot of just wishy-washy moves here. Perhaps the most consistent at this point, IYT, which is the transportation index. And then FDN, while it is starting to fall a little bit, it's certainly managed to hold on into this upper right quadrant for quite some time. And KRE probably would be one, regional banking, to kind of note. But it's hard to make a strong case for any of these except for perhaps IYT. Okay, we're well over 20 minutes at this point, so we often do that on Mondays with all the information that comes in over the weekend. Usually have a lot of morning reading from our various authors that we like to follow. So we're going to go ahead and hit the disclaimers. As always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll see you next time before the market preview of tomorrow. And in the meantime, manage that risk and good trading.